So I want to finish up my lecture on mutual funds, and I was talking at the end of the last lecture about hybrid funds, and I mentioned that I was going to discuss that in this video. So I am, but before I get to that, I want to introduce the topic of specialty funds. So there are two types of specialty funds. The first is called a fund of funds. And you know how I showed you for the Vanguard Total Stock Market Fund, it actually owned stocks in individual companies, and I'm actually not sure I showed you that, so I want to show you that. So let's go to the Vanguard Total Stock Market. I'm actually after this one. So it's the Total Stock Market Index Fund for individual investors, and I happen to know that it's mostly just US stocks in this particular fund. And this just verifies that. So about 98% of it is in the US stock market. And if I go to holdings, it has 3,800 stock holdings in it. So what that really means is it owns stocks in 3,800 companies. It actually owns more than 3,800 shares of stock. So if I scroll down a bit, as part of the free service, it just shows you the top 25 companies that it owns or holdings that it owns. In this case, probably all corporations. So for instance, Apple, it owns 101 million shares of Apple, which comprises 3.01% of its portfolio. Zoom in a little bit on that. And it owns 128 million shares of Microsoft, which is about 1.5% of its portfolio. So if I had access to the premium Morningstar service, I could actually find out all 3,800 companies that it owned. Here it just shows the top 25, and again, they're probably companies you recognize because these are going to be pretty big companies in the top 25. There probably is some of the 3,800, many that you've never heard of, because eventually some of them will get pretty small in terms of market cap. So a fund can directly own shares of stock, or to get back to what I was talking about, a fund can actually own shares of another fund. And if that's the case, then they call it a fund of funds. And probably the most well-known of those in Vanguard are the Vanguard Life Strategy funds. They have 4 or 5, and I only have 4 jotted down right here, but I kind of think there's a 5th one. So there's a Vanguard Life Strategy. They capitalize the S, I believe, in the word strategy, even though they keep it as one word. Growth fund, and then there's also an income fund, and then a conservative growth fund, and then a moderate growth fund. And I'm actually going to just take that out. These are actually 4 separate funds, and I'm going to go show you a couple of them. I think I'll look at the growth one and then the conservative growth one. So again, back to Morningstar, because that's the best resource for finding mutual fund data. And so Life Strategy, and we'll look at the growth one. So when I look at holdings, it says it doesn't own any stock and it doesn't own any bonds. Instead, it just has other holdings, 5. So if I scroll down to the holdings section and look, I can see they actually own shares in the Vanguard Total Stock Market Index Fund, the Vanguard Total International Stock Index Fund, and then a bond fund, which is mostly U.S. bonds, and then an international bond fund. And the bonds total about 20%. I'm just summing this 14% and the 6% because those were the 2 bonds. And stocks make up about 80%. So this was the growth fund. And you can see it owns 106 million shares of the Vanguard Total Stock Market Index Fund. So this is an example of a fund of funds. And if I go look at the Vanguard conservative growth one, it's the life strategy. Got to get it in there correctly. Again, it just has 5 holdings, and if I scroll down and look at them, it owns the same. It's only listing 4 holdings. I'm not sure what the 5th one is, but you can see it's the same 4 funds that it owns, but it just owns them in different proportions. For the conservative growth one, bonds make up 42% here. The majority of the ownership is a bond fund, whereas before with the growth fund, the growth life strategy fund, stocks made up the majority holding. So bonds make up 42% plus 18%, so about 60%. Stocks make up the other approximately 40%. So even though they hold the same exact 4 funds, they have a different mix. This is why it's a more conservative mix. It's more invested in bonds, which are less risky than stocks, which in finance we say a less risky mix is a conservative mix, whereas a riskier mix would be an aggressive mix. And then another example of a fund of funds, but it's also an example of another type of specialty fund, is what's called a target date retirement fund. And they're not all funds of funds, but the one I'm going to show you happens to be. So I'm going to show you the Vanguard Target Retirement 2055. Basically what investment companies like Vanguard do is they're trying to make it easier for individuals to make choices. Um, and so what they've done is they've started a mutual fund, and they're targeting it toward people who will retire 40 years from now. So that would be retiring in about 2055. Well, a person who has 40 years left until retirement should be invested in mostly stocks, if not all stocks, and a nice diversified grouping of stocks. So that's what this fund tries to do. And so let's just take a quick look at what it does. And I purposely didn't search for it before I started recording the video because I wanted to show you this. You can see they have lots of different targeted retirement funds for people who are going to retire in quite a few different time periods. And like here's one for people who are retired in 2010. Just because your target date is reached doesn't mean the fund ceases to exist. Rather, it invests in much more conservative things like bonds and starts paying out a lot more income. And I'll talk about that too. I'm gonna jot these tickers down because I want to pop over and show you something. So give me a moment while I jot these down. So here's one for a group of people who retired in 2010. And this one would be for people who are approximately 25-ish or so right now and are going to retire in 2055. So this is the one I want to look at right now, the one for 2055. And I actually want to look at the summary of the holdings just to get a broad idea of how this fund is invested. So like I had mentioned, a person who has 40 years until retirement should be mostly in stocks. And so they've got 53% of their money in stock or US stocks, 35 in non-US. So that's about almost 90% in stocks and about 10% in bonds and a little bit in other and cash. I'll explain why virtually every fund needs to have some cash in just a bit. And then let's just take a quick look at the equity mix for this particular one. So 90% of its money is in equity. You can see the bulk of that 90% is in large caps and some in mid caps, a little bit in small caps, And, some people might view this as just a perfectly fine mix. I personally would, if I were going to retire 40 years from now, if I had the luxury of that much time on my side, I'd maybe be a little more heavily invested in small caps and a little less heavily invested in large caps. I think this is perhaps just a tad conservative for someone who has 40 years to go. Um, and then let's look at the international mix. So down here, I can see that the bulk of that 90% in stocks is in North America, presumably the United States and not Canada. Um, and so only, 35% is outside of the US. And then they have about 6% in emerging markets. Again, emerging markets are quite risky, and maybe 6% is a good number. I can't tell you what a good number is to have in emerging markets or small caps or even stocks. Um, I think I'd be content with about 6%. But remember, it's not 6% out of 100, it's 6% out of 90 because only 90% of the money is in stocks. The rest is in mostly bonds. Now, I actually think having 10% in bonds for someone who has 40 years to retire until they're going to retire is, again, probably too conservative. I don't think a person at that stage in their retirement planning needs any in bonds. So I think this particular fund, even though it's geared for somebody to retire in 2055, I think it's being too conservative. But that's just me. That doesn't mean it couldn't be a component of my portfolio, but then I'd probably maybe put some more in small caps and maybe a little bit more, actually definitely some more in foreign. But that's just me. And then I also wanted to contrast it with the one that was geared for someone who had retired in 2010. So that was the VTENX. This one should look a lot different than the 2055 target retirement date, and it does. So you can see the bulk of their money is in bonds. It's still got some stocks, even though these people have retired already. Um, Retirees now have a good chance of living until their 90s, into their 90s. So if I retire at 65 and I die when I'm 95, that's still 30 years of living that I've got to finance somehow, and I'm not generating an income because I'm retired. I'm not generating an income from a job because I've retired. So having to save enough money to live for 30 years until you pass away is going to be difficult. Stocks tend to earn higher returns than bonds do, so you've got a better chance of actually accomplishing the goal of saving enough money to survive throughout your retirement if you invest in some stocks. And so people who retired in 2010 still have a decent amount, maybe a couple of decades until they're going to pass away. So they can still have some risk in their portfolio. They don't need to immediately shift upon retirement all their money into bonds or low risk securities. They can afford to go ahead and keep some of their money in riskier stocks. And that's why this portfolio is structured this way. Um, Now, why does a mutual fund need some cash in it? So let me just start uh, a little thing on the document about that. So why does a mutual fund need some cash? The reason is because anytime you own shares in a mutual fund and you would like to sell them, you don't sell them to another person. You don't sell them via your stockbroker. What happens is the mutual fund must always stand ready to redeem their shares if a stockholder wants to cash them in. Basically, that means buy them back from the stockholder or shareholder. can't think of a good word to use. Wish is such a bad choice, but whenever the shareholder says, I am ready to cash in my shares of this mutual fund, the mutual fund has to buy them from the shareholder. That's unlike stock. If I own stock in Apple, when I'm ready to sell my or get rid of my investment in Apple stock, I contact my stockbroker and tell my stockbroker to sell them, and my stockbroker would sell them in the stock market. If Apple's having a really bad day, the share price for Apple could be dropping, and my stockholder can't guarantee me a certain price, and it might take a little while to find a buyer, especially if it's a very small company that doesn't trade very often. Mutual funds don't work that way. They always keep some amount of their funds, their money, in the form of cash, so that every day they have some shareholders who are saying, I want to redeem 50 shares today, or maybe I want to redeem all my shares today. And so they always have the cash so they can transfer it to their shareholders in exchange for their shares. Now, there was something else I wanted to show you about the Vanguard target date 2055. Hopefully it's on here. It's something they call the glide path. Basically, here is where we are in the life of this particular fund. Eventually this fund will cease to exist because all the people who retired or plan to retire in 2055, after enough years have passed, those people will have retired, lived till the end of their life, and the fund will no longer need to be around. That might not happen until, 2080? But eventually the fund will no longer be needed. And they're always developing new funds because eventually there's going to be a need for a fund for people who are retiring in 2060 and 2065 and so on. But for this particular fund, the target date is 2055. That's year zero. But we're here at 2015, which is 40 years until 2055. So I'm trying to find the legend. Oh, that's not at all what I meant to click. Um, oh, there's the legend. So you can see right now the orange represents bonds. That's at about 10%. And the blue represents stocks, which is about 90%. And we looked at the breakdown of the portfolio, and that pretty much agrees with where they are right now. They plan to maintain this 90% stock, 10% bonds until about 25 years before 2055, or about 15 years from now. And then they're going to slowly start boosting the amount of bonds in the mix, reducing the amount of stocks in the mix, until eventually 5 years after 2055, so 2060, the mix will be at 15, is that, 25% stocks and 75% bonds. And they're going to keep it in that ratio until the fund dissolves because it's no longer needed. And again, this is called the fund's glide path. So I'm actually just going to put this here because I think a glide path is important to know of. And the only funds that I'm aware of that have glide paths are target retirement funds. Like these don't have glide paths. Okay, something else that you need to be aware of, and this is extremely important. That's the management style of the fund. There are two broad management styles. The first is an actively managed fund. With an actively managed fund, the people who manage the fund actively seek out investments. The manager believes are incorrectly priced. So, um, again, I don't necessarily think what I'm about to say is true, but it might be a thought process a manager is having. So, Volkswagen just recently announced that they had been misleading the regulatory bodies about the emissions in their cars. And their stock price dropped by about half, over the past week. So, there might be a manager out there who now thinks it's a great time to buy Volkswagen because the price dropped so much and they're perhaps really certain after doing lots of research that Volkswagen is going to be able to overcome this issue and bounce back and be absolutely fine. If that's true, then they would want to purchase some shares of Volkswagen because in their view, in the future, Volkswagen's price will rise. So right now, they believe Volkswagen's stock price is incorrectly valued by the market. Only time will tell if that thought process is correct. So the managers of those funds spend a lot of time and energy trying to predict the stock market, evaluating companies to decide if their stock price is correctly valued or incorrectly valued, trying to estimate where interest rates are going to go because that impacts the stock market and it impacts the price of stocks and bonds. So, an actively managed fund, the manager spends a lot of time managing the company. So, it's very time consuming. Because of that, it's going to have high fees. You have to pay a lot of specialists to work for that company to do all of this for the fund. One example of an actively managed fund is ViceX. That's the fund I talked about earlier that only buys companies in the gambling, tobacco, defense, and I can't think of the other one, the SEN stocks. I just want to take a quick look at the fee that you would pay. Oh, I keep clicking the wrong button. I want the quote. Here's the annual expense ratio for the ViceX fund, 1.44%. I don't know if you remember some of the fees for some of the other funds I was showing you, but they were like 0.14%. That's a big difference between 1.44% and 0.14%. So actively managed funds, you'll pay a much higher annual expense ratio. There's an entire chapter on expenses, so I'm not going to delve too much into this right now, but I'll just say it it costs quite a bit of money. I'm going to pop over really quickly just to a spreadsheet and do a quick calculation. That annual expense ratio is paid annually. That's why it's called an annual expense ratio. Let's say I've got $300,000 invested in a fund, and I invest it all in ViceX, which is charging me 1.44% a year. Um, 1.44% times 300,000 is $4,320. And I'm just going to use 0.14% because I know one of the funds we looked at had that fee. Look at the huge difference in the annual fee that you're going to pay for this actively managed ViceX fund versus a passively managed fund. I can't remember which fund this was, but maybe it was the Vanguard Total Stock Market Fund. I think that's actually what it was, with a 0.14% fee. This is actively managed, this is not. Now, active managers will argue, well, we're charging you such a high fee because we're going to do such a great job generating returns for you. And they might some years, but they might not other years. I'm not sure how ViceX is done, so I'm going to just pop over to performance and see. And I want to look at a longer time frame because it's not really fair to compare them just during a bull market or just during a bear market. You need to look at a long time frame that covers all these different types of markets. I've got some weird issues here, but we can still see well enough how it's done. So, like in 2006, they earned 23%. In 2008, this particular VICEX fund lost 41%, gained 18%, 11%. Um, Whereas the U.S. stock market, so the S&P 500, here in 2005, VICEX did better. In 6, it did better. In 7, it did a lot better. In 8, it did worse. In 9, it did a lot worse. In 10, it did better. 11 better. 12 better. 13, it did about the same. In 14, it did worse than the overall U.S. stock market. So it looks like it's about an they're almost neck and neck because the blue line up here is the VICEX fund. The green line is the S&P 500. Um, we started out here with $10,000. After a decade, which is what this is tracking, I've ended up exactly the same uh, for the two funds. But if I put my money in a, an index fund that tracked the S&P 500, I would have paid a much lower fee than putting my money in the VICEX fund. So again, actively managed funds have extremely high fees compared to passively managed funds, which I'll pop up here in a minute. And the issue with actively managed funds is they fail to consistently, and that's important, that one word is important, they fail to consistently outperform the overall stock market or the overall market. They certainly will outperform some years, but they underperform other years. But you still have to pay that high fee regardless of whether they outperform or underperform. The other type of management style is the passively managed fund. These are also called index funds. And their goal is to emulate an index such as the S&P 500 or the Dow Jones Industrial Average. There are many indexes, hundreds of indexes. I'm only listing two. Oh, actually, and another one, it's called the CRSP, which stands for Chicago Research and Security Prices. It's called the CRSP US Total Market Index. That's one I kind of like. It's broader than both the Dow Jones Industrial Average and the S&P 500. The Dow Jones only has 30 stocks in that index. The S&P 500 obviously has 500. The CRSP US Total Market Index has, I believe, about 4,000. So, for a fund whose goal is to emulate an index, what they'll do is analyze the index. And they'll break it down by geographical location of the companies in the index. So are they US based? Are they foreign? If they're foreign, what region of the world are they based in, etc. Are they oops, are they in developed markets or emerging markets? They'll break it down by market cap. They'll break it down by whether the company pays dividends or does not. They'll break them down by sectors. And so let's say they're trying to emulate the CRSP US Total Market Index, which again has about 4,000 companies. This one's actually all US. That's actually not entirely true. They have a few non-US companies. They have some very specific requirements that I'm not going to get into. So even though like 95% would be US, maybe 5% is foreign. And so the bulk of them, I'm pretty sure they're all developed markets, no emerging in the CRSP US Total Market Index. But it does have all 5 different market caps. It's got some that pay dividends, some that don't. It's got companies from every single sector. So what they'll do is just segregate all the companies in the CRSP Total Market Index to get a good feel for exactly how many are in all these different categories. And then what the index fund will do is select a subset of all of these 4,000 companies. And that subset, they'll pick some from the developed markets, some for small caps, some from mid caps and giant caps, some that pay dividends, some that don't, some from each of the sectors. And they might form a portfolio that has, let's say, 1,000 companies in it. And it's designed to emulate the 4,000 companies that make up the CRSP total U.S. Total Market Index. But because it's only got a subset of the index, it won't do a perfect job of emulating the index. But the bigger the subset it contains, the better the job it will do. The first index fund was developed, I believe, in 1972. And it was the Vanguard 500 index. And its goal was to emulate the S&P 500. And it started off really small. It chose a subset of companies just using the process I just described. What happened, though, is probably in the 1980s, maybe a little bit after that, people started noticing that these actively managed funds didn't really consistently outperform the market, and so they started pouring their money into index funds. So I just want to show you the Vanguard 500 now. It has, let's see, $205 billion invested in it. It's got nice low expenses. That might seem high to you, but 0.17% is quite low. And if I go to portfolio, oops, wrong. Well, we'll go ahead and look at performance. Since its job is to emulate the S&P 500, this blue row and the VFI and X row should be very, very close. And we can see that it is. And if I carried it out to the last decade, these two numbers would still be quite close. I've been following this index fund for a long time, and I know that they do a good job of emulating the index. One reason they do is because if we look at portfolio, down here are the different sectors. So here's the 11 broad sectors. Here's the percentage that the Vanguard 500 has invested in each sector. Here is the overall benchmark, which is the S&P 500. So the Vanguard has 2.76% of its money in companies that operate in the basic materials sector. The Vanguard has 3.01. So, I'm sorry, the S&P 500 has 3.01. Vanguard's a little underweighted in this sector, and the consumer cyclical sector it's a little underweighted as well. But you can see it's not bad. It's actually fairly close for all of them. And it's underweighted in some sectors, overweighted in other sectors. And it also, if I look at holdings, it actually owns 504 companies. So it owns stock in all the companies that make up the S&P 500 and then a couple more. So it doesn't own a subset of the S&P 500, it owns all of them. So you should expect the Vanguard 500 to do a great job of emulating the S&P 500. I'm a big fan of index funds. First, they charge very low fees typically. And second, over the long run, they tend to outperform actively managed funds. It just doesn't make sense to pay the actively managed funds high fees when they don't consistently outperform. Now some index funds, use what is called enhanced indexing. Not that many, I don't think, but I'm going to just say beware of enhanced indexing. Enhanced indexing is basically the majority of the money that the company manages. And I'm going to put money. Funds is also another word for money, but the topic is mutual funds, and I don't want to confuse the issue. So the majority of the money invested in the fund is used to emulate the index, but a minority or a small portion of money invested is actively managed. Boy. So what they're trying to do is emulate the index with this majority of the money, but with that actively managed portion, they're hoping to outperform the index to boost the total returns of the fund to be above that of the index they're trying to emulate, so that shareholders of the fund will be really happy. But unfortunately, with that actively managed portion, they don't always outperform the index, and so it can pull the performance of the fund to be below that of the index they're trying to emulate. So I don't like, oh, I accidentally hit the wrong button. Uh, I don't like enhanced indexing. When I buy an index fund, I want it to be a 100% an index fund. The only way to really tell that is to read about the fund. So if you go to filings, hopefully that took. So if you go to filings, you'll see what's called a prospectus, which is just a document that every fund has to release to their shareholders, and it contains information on who manages the fund, uh, how the money is distributed across cash and bonds and stocks and foreign equities and things like that. What the fees are, how much an investor would pay in fees if they held the fund for 1 year versus 3 years versus 5 years, etc., etc. But it will also give you a couple of paragraphs on the goal of the fund and how they manage the fund. Read that prospectus to make sure it doesn't mention anything about enhanced indexing.